My name is Jonathan Wages. I'm a economics student at Texas A&M University. I talk a little bit about the stock market and stocks today. So according to the Fed, there is about $15 trillion in the stock market. So to put that in perspective, our total national debt is about $20 trillion. So about 3/4 of that is what the stock market is made of. Now it's not made of the debt, but prospectively money-wise. So I've been studying economics for about 4 years now. That's what I do every day. Listen to financial advisors from Wall Street, do interviews with a lot of financial advisors that come into Texas A&M that were graduates. We have a lot of seminars with them about different investment strategies, different market plans, different things that stock trends, different stuff like that. So today I'm going to tell you a little bit about the different like stocks and stock markets as a whole, and then what those components of those of stocks are, as well as how people use those components to their advantage through day trading or long-term investment strategies. So what a stock is a stock is it's a share. And so what a share is it's a way for you to buy a portion of a company. And so you might be thinking, well, why would a company want you to own part of it? That's because it significantly increases their capital, which allows them to broaden their horizons. They can get more money to buy other businesses. They can get more money to invest in other things. They can expand their technology. They can do more research. They can build more stores. So you buying a share is basically giving them money to do things, and in return you own a portion of that company. And so the market is basically where you get to do all of that. It's like a retail store where you would go buy clothing, but it's the target of the stock market, where it allows you to go in and browse their selections and see what you would like to purchase, and then you purchase your stock from them. And so all that's done with certified third-party users such as Merrill Lynch or Robinhood. And so now that you know a little bit more what a stock is, they have several different components. And so a few of those components would be the volume, which is how much of that stock is traded throughout the course of the year. And then you have the average volume, which would be how much is traded throughout the day. So how much of that stock was bought and sold that day. Then you have the market cap, which can be found by, so Ford stock has about 27 billion market cap. And so that is, if you divide that by the price, so Ford closed today at about $6.90. So if you were to divide that 27 by $6.90, you would get how many shares there are, and it's about $4.5 billion shares. There's about 4.5 billion shares of Ford that can be bought and sold. And then you have a thing called PE, which is the price to earnings ratio. And so what that is it's a ratio on a scale of about 1 to 15, 1 to 20 or so, that shows you how well a stock is doing, how well a company is performing. So if hypothetically Ford had a price to earnings ratio of 15, that would mean that its stock is trading at 15 times its value. So that means that Ford is doing very well because they're trading at 15 times their value. So it's projected that Ford will continue to expand, do well, and go into different research. So Business Insider says that a high PE ratio would be the best way to determine a company's growth and how well it's going to do in the coming months. So that's what Business Insider's input on that. And so these components allow us to learn how the wealthy individuals of the world use this to their advantage. And so one of those would be long-term investments. And then so one of those components they use is called a dividend. And so what a dividend is an interest rate that you get paid for owning a stock. So Ford's dividend is 8.82%. And so what that means is at the end of the year, you get paid 8.82% on the money that you bought of Ford. So if you bought $1 million of Ford, they would pay you 8.82% interest. So it's kind of like taking a loan from a bank, except you get paid for basically loaning that company money when you bought their share. And so another thing would be day trading. And so what day traders look for is a thing called high volatility. And so what high volatility is a stock that changes price very rapidly. So at one day it could be here, and then it could jump up here. So say this is $10, and then it jumps up to $15. So it starts at 10, goes to 15, and then say it goes down to 5. So then it goes to $5, and then jumps back up to, we'll say, 12. So that would be a stock with a high volatility. because it rapidly goes up and down and up and down. And so that allows investors to try to catch it on the downslope, so where they were to buy it at $5 and then sell it at $12, make a large percent of profit, and then do that just every week until they eventually have just this excess amount of cash because they've made hypothetically 10% or 5% every week. So to put that in perspective, if you were to start with $100 and make 5% on your money 191 times, you would then have $1 million after that $100 investment. And so that profit range is astronomical. So basically what we explained today was what the market was, what a stock is, the components of those stocks, and how the wealthy or how investors use those components to their advantage, and how they use that to make their money work for them. So now that you've been told this, definitely go out, try to diversify your portfolio, look into stock trends, see if you're more of a long-term investor, or maybe are a little more risky and you want to do that high volatility trading as well. So thank you, and you have a good one.